One of the most underrated things when it comes to quantitative trading is its ability to eliminate irrational decision making when it comes to investing or trading. I believe this topic is not talked about too much. It's probably one of the most attractive things that will attribute to your success when it comes to trading and investing. And in this video, I want to talk about how that is so. Without further ado, let's jump right in. Welcome. If you're new to the channel, my name is Matt Jimenez. I'm an entrepreneur who has worked with the greatest minds in finance over the last several years, and I'm here to pour into you guys everything that they pour into me. When it comes to trading and investing, there are a plethora of inputs that happen that lead to you making decisions that you may want to make in that moment and may regret later, or have thought out quite thoroughly, which led to you making the right decision. Either way, you're influenced by something that led to a decision. And this goes back to the beginning of time. External circumstances always conflict with our internal circumstances, which lead to us making decisions. Oftentimes, these decisions are made off the back of an emotion, and that's what I'm talking about today, is our decisions influenced by our emotions. And when it comes to trading and investing, that is very prominent across the board. Whether you're a professional or a novice, there is nothing that you can do that will eradicate your emotions in the marketplace. But understanding your emotions and understanding how they impact your decisions will ultimately allow you to recognize when you're being influenced by your emotions to pull you away from making an irrational decision. No matter how logical you think you are or how stoic you can be, the only thing that combats logic is emotions. The more emotions that are involved, the more logic goes out the window. There is a whole topic revolved around behavioral finance and behavioral economics, where there is an array of studies that show exactly how our emotions impact our decisions, especially when it comes to trading and investing. All of us, knowing or not knowing, use behavioral finance in our every single day activities. For instance, we all do mental accounting. Mental accounting refers to the propensity of people always allocating X amount to X amount purpose. And that's one of many. And today I want to go over a couple other ones that are extremely prominent when it comes to being a trader and or investor. The first one that comes to mind is loss aversion. And what loss aversion means is people tend to feel the pain of losses more strongly than the pleasure of gains. This can lead to investors selling their winning investments too early to lock in gains and holding on to losing investments in hopes that they will bounce back. This is one of the most common things that I've found, especially in my own personal practices, trying to be a trader and or investor, is we want the instant gratification of a profit, so we typically don't let the winners run. And the reason we end up holding on to the losers is because we're so strongly addicted to the feeling of pain of a loss. This is why people always gather around together and talk about some incidents that caused pain or loss in their life rather than a win. And this is very common. And I know there's a select few of people that are the contrarian side of things, where they're positive and they get around and they talk about their wins, but that is more unlikely than not. In fact, even the winners sit around each other and they always talk about some type of loss that they overcame. It's because people are addicted and cannot get over the feeling of pain and loss. We are hardwired that way. In fact, the next one that I want to talk about is overconfidence, and I myself have been subject to this as well. Overconfidence basically states investors may overestimate their ability to predict the market and make successful trades. This can lead to excessive trading, higher transaction costs, and poor investment performance. Typically, overconfidence is bred by the very few in between winnings. What I mean by that is, let's say I go and take 5 trades. The last trade being a winner, I will use my past experience of that last trade of being a winner as fuel of confidence for the next trade. And if that happens enough times, I will become an overconfident investor, which will allow me to take more trades than is necessary, and it will affect my performance long term. But ultimately, whether I succeed or not, it will increase my transaction costs because I'm so confident that I'm continuously taking more and more trades and more size on the trades. Overconfidence will be detrimental to your portfolio 100% of the time. The third thing that I like to talk about is the herding behavior. The herding behavior is investors following the crowd to make investment decisions based on actions of the others rather than their own analysis. This can lead to asset bubbles and market crashes. One of the most prominent examples I could think when it comes to herding mentalities is back in the .com, where everybody was flocking into these .com stocks that were going up exponentially because of all the buying pressure going into these random companies popping up saying that they're going to do X, Y, and Z with their domains. And this is where you have pets.com and all these random things popping up. They're here today and gone tomorrow. It's because people tend to feel like they're missing out on a massive opportunity because all these other people are going into it. And the moment they feel that is the moment they become part of the herd and rush to move into this opportunity that has presented itself as the end all be all because everyone else is doing it. In fact, you cannot deny that many times in your life when you've seen many people doing something, you almost feel that you need to do the same. It's because we are meant to be that way. We are hunters and gatherers, and we always moved in tribes. We've never moved isolated. We've always had community. And what the community does, you end up doing, because community breeds unity, and unity moves as one. So if you see some people wearing a bunch of silver shoes, you're going to find out the name of those silver shoes, and then eventually you're going to end up wearing silver shoes. This is why you see so many people following trends of fashion. It's because it's the mechanism of being a herder, and that is inevitable. The only way to block that is to actually disassociate yourself with communities and ignore all market sentiments. Unfortunately, that is quite impossible to do, but I have the solution to basically all of these. But before I get into the solution, I want to talk about one more that can impact your performance when it comes to trading and investing, especially revolved around the topic of behavioral finance. And this one is called the anchoring bias. This is by far one of the most influential ones when it comes to somebody that's already experienced when it comes to investing, because this is the one that typically latches onto you and anchors off of your emotions, hence the anchoring bias. And basically what this states is investors may anchor their investment decisions to a particular price or value, leading them to hold on to investments longer than they should or miss out on opportunities to buy or sell. As you can see, you need to be somebody that was an investor or is an investor to ever feel the anchoring effect, because you've already had to have some type of relationship to a particular asset, like Bitcoin as one. The reason why I bring Bitcoin up is because I got a Bitcoin shirt on. I was actually out in Bitcoin Beach a couple years ago, so I'm going to use Bitcoin as the example here. Anchoring effect would happen to somebody that has already bought Bitcoin, particularly someone that was lucky with Bitcoin and bought it early. You're more likely to be susceptible to this exact effect. So what happens is, let's say you bought Bitcoin at $10,000. Well, that price of $10,000 is now anchored into your psyche. And as price increases, you get more and more adverse to buying more of Bitcoin, even though you know it's probably going to 100,000 or further. You don't do it because you don't want to affect that $10,000 initial purchase price, because as you buy more and more, as price is increasing, you're changing your average cost at what you got Bitcoin at. You tend to anchor to the $10,000 price, and you let all these other buying opportunities slip your hands because you don't want to affect the price you got anchored in at. And that has been something that has affected me time and time again in all the markets I've dabbled in, especially when it comes to early stocks that I've bought. Now, on the flip side, it also affects you because when you hold an asset, you get not only anchored into the price, but you get anchored into holding it. Meaning when we are presented with really good selling opportunities, we tend to continuously hold because we're anchored in the idea of it never being sellable because of your relationship holding that asset. So those are just a few of many different things that happen to people's psyche when it comes to behavioral finance and investing. It completely will destroy your portfolio if you don't overcome them. And this is why most people actually lose money when it comes to investing. This is why financial advisors have came about. This is why there are different mechanisms of stewarding your investments. Since it's your own, you're emotional with it. But when someone else or something else stewards it, the emotion is eradicated because now it's not you stewarding it. The responsibility is on something else. And this something else, no, I'm not speaking on a financial advisor. What I'm speaking on is quantitative trading. It is merely just software that trades on your brokerage account for you, and it does all the decision making for you, and it does all the holding for you and all the selling. So you absolutely eliminate the variables of behavioral finance, especially those 4 traits that I went over, when it comes to allowing software to take control or some type of stewardship over your portfolio. And if you want to know more about quantitative trading or what these softwares even are, just hit the link in the description and you'll be routed to speak to somebody who can inform you on everything you want to know. But if not, hopefully you got value out of this. And if you did, please leave a like, comment, and or subscribe. And like always, my friends, peace.